Hello friends, welcome to my channel. Good afternoon, good morning, good evening, whatever time you're watching this video. Before we get started with our topic for the day, which is Option Straddle, let's go to the disclaimer and spend some time on this. Okay, so let's get started. So what is a straddle? As you are aware, we are covering the Option Basics series, and this is the first strategy which I'm going to cover. This strategy is called a straddle. So what is a straddle? A straddle is a neutral strategy that involves buying or selling both call and a put option for underlying stock or index with same strike price and same expiration date. Straddles are made mostly at the money or near at the money. So selling both call and put, it's called as short straddle. If you're buying both call and put, it's called as long straddle. So both these strategies are used at different situations. One, short straddle is used when the market is range bound and when you are not expecting much of a trending movement. And long straddle is made when you are expecting a news or there is an event or there are results which are going to be declared. So long straddle will help us to capture that particular result. Okay, now let's understand how to create a short or a long straddle. The basic things what we need to do is we need to choose a strike which is at the money or near at the money, which has equal or near equal premium, and sell or buy both the strikes at 10 a.m. in the morning in a stable market period. I'm talking about intraday here. So the right time when you have to buy a straddle is after 9:40, which can be 10 o'clock or 10:15, because the most of the volatility period will be over by that time. And where do you keep your stop loss? You have to always go and check the day high for that strike and use the day high as your stop loss. Just 1 point above the day high, you have to put a range. Like in options, if you put a same price, it will not get hit. Usually the price jumps. So always keep a range like 298 and trigger price will be 299. That kind of range you have to keep. And quantity has to be as per risk management rules, which is 1% risk on capital. And the formula will be like 1% risk on capital, say it is 2000, then divided by your entry price minus the stop loss price. So when you choose an entry price, then you look at the day high stop loss where you're going to keep, minus that, and you get some points. So that will be the uh, used for this calculation, like 20,000 divided by 50 is equal to 40 quantity is what you can trade, so that your risk is defined. If day high or low stop loss is hit, then you can understand that the market is trending in that direction. So usually if the market is range bound, your day high stop loss will not be hit. Once the stop loss hit, you need to start trailing your stop loss on the other side, which is in positive, if you are comfortable. If not, if you have any confusion, then you please close the position and wait for the next signal. Simple. So mostly either you'll be in profit, minimum profit if the day starts trending, or you'll be in a minimum loss, because you have defined your risk and you will not lose much money in this strategy. Okay, this is how a long straddle will look. We'll go to the chart and we will look at the option chain in detail, but let us understand how the payoff diagram looks for long straddle. So long straddle is good before the event to capture big moves. Max loss is defined, as you can see in this example, it is 31,400, and the market, if it goes into range bound movement, you will incur loss. And don't initiate if premium have too much variation. Now what do I mean by saying that premium has too much variation. See, if you have call price premium about 200 and put price premium is about 70 rupees, then it is not a suggested time to write a straddle, because there is too much of a variation. You will not be able to balance it if any violent move happens. So the premiums will be good to go, like if it is 200 on the call side and 195 on the put side, it's an ideal premium which you can go and write a straddle. So let's go to the short straddle. Short straddle, similar, vice versa image of the payoff diagram. Here your profit is defined but your risk is undefined, and if the market stays in the range, you're going to make profit. So mostly option writers and follow this kind of strategies on a daily basis to capture the range bound time period where the market doesn't do anything, and they make quick money out of this strategy. Max loss is undefined. Range bound movement will help you to make profit. Don't initiate if premium have too much variation. As I said, the same rule applies for both. Value on both sides should be near equal. Now this is an interesting point. Most of the people look at the premiums and look at the quantity, say that if you are selling one lot here, it has to be one lot there, but always look at the value. If you are having a premium which is at 180 on the other side, and one lot into 180 will be a different price, and the 200 into 180 into one lot will be a different price. So you have to always keep what is the value which is coming, which is like it should be equal or near equal on both the sides, so that your delta is properly managed and hedged. Now let's go to the option chain and check, like how do we identify this. Let's go to bank nifty. So spot is at 29,876, at the money is 29,800, call premium is 495, put premium is 328. So there is a lot of imbalance in this strike premiums. On 29,900 it is 435 and 365. Even here there is a lot of difference, but still it's about 100 rupees difference, still manageable. So you can go with 29,900. So you know how to check this. We'll go to Option and we say reset, choose bank nifty, and then options 3rd October and sell 29,900 put. See the price, one lot, and 29,900 call price, another lot. Okay, so this is how it will look like. So when I say value, it has to be like 365 into one lot. What is the value? Like for example, let's go to calci. 365 into 20, this is 7,300, and 435 into 20 is 8,700. So 7,300. There's difference of 1,400 rupees. Okay, so which you can manage. So this should not grow with the time. So you know then you'll start incurring loss. Okay, so there are various adjustment techniques which you can follow, and you know that will cover up in detail in next week's session or maybe sessions after that. First I'll cover all the basic strategies: options, straddles, triangles, vertical spreads, all these things which are useful for you, and then we will look at the adjustment strategies. So when I say day high as a stop loss, you can actually see any of the graphs. Let me just try and show you one of the gap. Okay, so this is 30,000 call strike. What was the day high? So the candle opened here, day high was here, which is like 597. So your stop loss has to be above this. This happened by 9:40. It has created the day high, which is 600 rupees, and after that it came up to 564, but it never touched the day high. So this is how you have to ensure. In a range bound market, the day highs will never be hit. So I hope this strategy is pretty simple and clear for everybody to understand, and hope you liked my video. And if you have any questions, you can definitely ask me in comments, and do subscribe to my channel and get the latest notifications. Thank you so much, guys. Thank you for watching. Have a great day.